Stocks kicked off this holiday-shortened week with a little bit of a whimper. The S&P 500 was down 0.63% today, which of course caps off the month of May there as well, and what a month it was. The S&P 500 had its worst month since March of 2020, of course the lows of the coronavirus wipeout time period. In fact, this was the 7th worst month for the S&P 500 over the last 20 years. And so I think a lot of us are happy to say goodbye to the month of May and welcome in June. June, by the way, according to the Stock Traders Almanac, has shown some bullishness on the first day of the month. Out of the last 33 years, the Dow Jones Industrial Average has been up 26 out of those years. So hopefully the calendar helps us along tomorrow as well. So we'll take a look at all of that. We'll also look at what it means for our postures. Let's go ahead and get started in tonight's video. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's May 31st, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. We're also heavy users of Twitter. My handle is @BrandonVanZ. We really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence over on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and dive into the charts. And as you can see here, I've got a slightly different looking chart in front of us. I thought what we would do to start things off here today is to look at monthly candles to kind of grasp how bad of a month we just went through in the month of May. And of course, this includes last week's rather strong 6% rebound. So if we didn't get last week, of course, things would look even worse than they do. As it stands, you can see that this was still a pretty ugly looking candle down below here, this red one off to the right that I'm kind of pointing at with my mouse. You can see it drops all the way down here, and that was good for a loss of about 8.79%. So nearly a 9% loss in the month of May. Pretty ugly there, all things considered. You can see that with some of these other prior candles, you'll notice here that the March of 2020, of course, extends lower than it. You also had another candle right here in December of 2018. Some of you will recall that was that Christmas time period that we had a big wipeout into the year end. We also were down a little bit more during that month. And then we had 3 months during the great financial crisis that we were down worse, which would have been February of 09. Remember, that called the ultimate low from a monthly perspective at least. But in the fall of 08, we also had a couple of pretty ugly months there, with both October and September back to back being worse than what we just experienced. And then the only other time in the last 20 years that was worse than what we just experienced was this one back here in September of 2002. Now, of course, this is only a 20-year rolling time period, so if we went into 2001, we'd probably have a few more weeks like that. But that at least puts things into perspective for you. As I mentioned before, it has not been a walk in the park. This is the 7th worst month in the last 20 years that we just witnessed. So we'll see where it takes us from here, but you can kind of see how the candles are structured up above here, where we've had this kind of significant rolling over type of effect, and we're trying to find some areas of support, but there's a lot of fear out there, of course, that where things stand here currently is we're in the midst of a bullish rally within a more bearish pattern moving forward. Of course, that can change, and hopefully it does. Hopefully we have economic reports and what have you that come out more bullishly than bearishly. In fact, we did have Salesforce.com, a Dow component these days, did come out with earnings after hours tonight, and the stock was trading higher last I checked. We do have some data to be aware of this week in terms of economic data. Remember that this Friday will be the first Friday of the month of June, and so we'll have some important jobs information coming through as well. You can see that the VIX did fall down to about 26 here as we ended things here on the month. Let's go ahead and do our normal chart review now, and we'll start off here with chart 4B. This is our foregrid, and this will include the 4 major U.S. equity indices, with the S&P 500 in the upper left, Dow Jones Industrial Average in the upper right, NASDAQ Composite in the lower left, and Russell 2000 in the lower right. Now, one thing that you guys should see as we start taking a gander at this is that we do have light green backgrounds across the board. And what I'm referencing, for those of you that are newer, this area right here that I'm kind of circling with my mouse is that light green color, as is this, as is this, and as is this. And so what that signifies in these charts cases is that we have had some bullish progress recently, so we want to be able to account for that. And the market forecast technical indicator readings that we reference in this video, unless stated otherwise, will be these green lines that you see down below. Now, if you're newer to this video, be aware that this market forecast technical indicator is something that can be found on the Thinkorswim platform over at TD Ameritrade. We do kind of dress it up a little bit, as it were, with some of our customizations here through ThinkScript, but the basic market forecast technical indicator is available there. It's not available on other brokerage accounts, to my knowledge, since it is proprietary to TD Ameritrade, but is at least one way for us to try to gauge what's been happening in the markets and how we can set our expectations moving forward. And you'll notice that with these green lines, which we also refer to as the intermediate line, we have popped out of the lower reversal zone on all 4 of those charts within the last week or so. And of course, that was driven largely because of what we saw with some of those really big candles that we saw last week. Today didn't help because today all 4 of these charts were a little bit lower. The S&P 500, as I mentioned before, was down 0.63% today. Dow Jones Industrial Average was down 0.67% today. NASDAQ Composite was down 0.41% today. And the Russell 2000 was down 1.26% today. So the Russell 2000 was the worst performer here today, and the NASDAQ Composite was the best performer, although still down 0.41%. So today didn't help in that trajectory. However, because the 3 previous days were so dramatic, in fact, for the Dow, we'd actually been on quite the winning streak. It was 1, 2, 3, 4, 5, 6 days in a row on the Dow. The others didn't have that because there were a day of selling here and there kind of mixed in between. But it does give you at least some impression in terms of how robust that rally was last week. We don't see a whole lot of those types of 6% up weeks throughout history. So it was a dramatic one, and one that we had been waiting for quite some time, with, of course, the 7 weeks prior to that being to the downside, which is very rare in its own right throughout history. So after 7 weeks of selling, we finally got a nice reprieve last week, an epic reversion to the mean type of a move. And now we're starting to test some of those overhead resistance areas. And, I'd say we're doing reasonably well on that count thus far, but of course we're still early in the game. And so, as I mentioned last week, one of the key areas that I'm keeping my eye on is how do we respond to that falling 30-day moving average? And so far, I would say that we're responding reasonably well. It's not perfect. You obviously would have preferred to see markets continuing to go higher today, which did not happen. However, you've got to give credit where credit is due, and you will see that 3 out of these 4 charts do have a yellow moving average. Now, for those of you that are newer, that's a 30-day moving average. And when it's yellow, it's basically a sign of conflict. In other words, it's a yield, sign on, let's say, the street light, right? Where green usually is go, red is stop, yellow is kind of yield or caution because there's mixed signals out there. And what it means in this particular case is that price of the S&P 500 price of the Dow Jones Industrial Average and price of the Russell 2000 are all trading above their 30-day moving averages, which by itself is a good thing. The problem is the moving averages are still going down, so that's why we have that conflict there. The moving average is going down, but price is above it. Now notice that the only one we can't make that claim on is the NASDAQ Composite. The NASDAQ Composite still has that red moving average right there, signifying that price is below a falling moving average. And so it wasn't a great look for it today to not gain any progress there, because it gives you the impression that it might be using that 30-day moving average as a little bit of a resistance area there. Now, another thing that I wanted to point out is that in one of these charts cases, we have what's known as a bullish intermediate confirmation signal. And that chart is on the Russell 2000. That occurs when the green line is considered to be bullish and the red line is in the lower reversal zone at the same time. And that is what we have right now. That is what we would reference as a buy the dips type of a signal. Of course, you generally want to buy the dips in stronger trends. This is only considered a weakly strong a weakly bullish posture, not a strongly bullish posture. So it's probably not all that relevant here, but because it exists, figure I better at least point that out for you. Let's go ahead and step away from the charts here briefly. Thank you to those that helped support us the last time that we did the video, or the last time I did the video on Thursday. Unfortunately, we did come up shy for our goal of 100 likes. Only 86 of you managed to go out of your way to click like for us there. And as I always say, as long as we're up and over 100 likes, I'm happy to do a full-length video for you. If we're below 100 likes, then we'll just do a quick hitter video on only the indices themselves. That'll be about 15 minutes there. So again, if you appreciate these completely free videos to you that we take time out of our day to do, all we ask is one simple thing out of you. Help support us by clicking like for us there on Twitter. Should be pretty straightforward there for you. This is actually, to my knowledge or recollection, the first time in the year 2022 that you guys did not get me 100 likes. So you went 5 months, quite a streak in its own right, but for whatever reason on Thursday just didn't quite pan out the way that I would have wanted it to, even though I think that NVIDIA trade is doing quite well. In fact, I think all of our trades that we've been doing here lately have been doing quite well. Notice that these are the open positions I still have in the market outlook category in my paper money account. And these are all profitable positions as it stands right now. Now, to give you full disclosures, remember we were stopped out of those beer trades that I did. So I did end up having to take losses on those. But of all those that remain open, these are all winning trades. And remember, you can see all the profits over here on the right-hand side. You can see the P&L percentage here in the green. And these are not even all bullish or bearish trades. There's a mix there, right? So we have AbbVie and Texas Instruments as two negative delta trades or bearish trades. And then all the rest of those in between are positive delta, are bullish trades. So regardless of whether they are bullish or bearish, they have resulted in profits over here. So remember, if you like these free videos and you want me to bring you trade ideas, especially if we've been doing pretty well with the trade ideas here lately and making profits, I would assume you want to see more of that. So one simple request out of you. Click like for me there on Twitter. I know you guys will get right back into the swing of things here soon enough. All right, let's go ahead and get back on track with some more index review. And we're going to go ahead and do our 3 green arrows chart, and this is chart 4D. And as you can see here, we do have 3 out of the 4 charts with that green background color on chart 4D. And what that signifies in this case is that we do have 3 green arrows on those 3 charts. The only one that did not out of these 4 is the NASDAQ Composite. 3 green arrows is just another colorful way to talk about 3 different technical indicators: the 30-day moving average, the MACD histogram, and the stochastic, to determine whether we have bullishness or bearishness at that particular moment in time. So that's a more bullish feature when we've got those 3 charts kind of locked into place there. Obviously, there's still a lot of work to do from a trend perspective, but if there is going to be a legitimate reversal, it's got to start somewhere. So it is possible that's starting at this moment. Whereas once again, we can identify the NASDAQ composite as our laggard at this moment in time, just like I had mentioned on the previous chart, where you still had the NASDAQ being the only one with the red moving average. Here's another instance where it's just lagging at this moment in time because it's the only one out of these four that does not have a 3 green arrows signal at this moment in time. So the NASDAQ continues to be our laggard at this exact moment in time. And then let's also take a look here at our 1040 crossover method. As you can see, not much has changed here. We remain with bearish crossovers, or what you might refer to as death crosses, on all four of these charts when looking at the 10-week moving average with the orange line versus the 40-week moving average with the blue line. And so in this particular case, I would say that we're kind of in the midst of a temporary bullish bounce. However, the trends from an intermediate to longer time period are now more bearish and negative. So that is what we are up against as we kick forward throughout the summer. So that's your quick hitter video tonight. Again, appreciate you checking out this free video. It looks like I'll actually be able to eat dinner with my family tonight. I guess that's the bonus side of it. And also, you guys will get this video a little bit sooner as well. But if you want me to get back in the habit of doing a full-length video, including 12 grid chart analysis and trade application examples, click like on Twitter. If we're up and over 100 likes, I'll be happy to do that for you when I'm back with you on Thursday. Until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.